Hey everyone, I know you've all been sending us questions about all the crazy stuff happening in the markets lately.
Yeah, definitely a lot going on.
Tariffs, oil prices going nuts, gold hitting new highs, and then you've got Palantir doing all this wild stuff with AI. I mean, you've sent over articles, research notes, even a CNBC video clip. You're really trying to figure out what it all means for you, for your investment.
Right.
And that's exactly what we're going to do today. We're going to deep dive into all of it.
Yep,
No jargon, just the need-to-know stuff.
exactly. Break it down.
Okay, so let's kick things off with something you flagged as a major concern, these tariffs Trump just announced.
Yeah.
Canada, Mexico, China.
Uh-huh.
And CNBC has this expert saying they'll basically act like a sales tax increase for us, for U.S. consumers.
Yeah.
So what's the real deal here? Like, what are tariffs anyway?
Well, tariffs are basically taxes on imported goods.
Yep.
So when they go up, those costs, well, they often get passed on to consumers, like you.
Right.
So you end up paying more for everyday things.
So like groceries and gas and stuff like that.
Exactly, things like that. And the bigger worry is that these tariffs could start, could trigger a full-blown trade war.
Okay, trade war. So what does that actually look like?
It's kind of like a back and forth battle of tariffs, right?
Right.
One country raises tariffs, and then another one retaliates with their own tariffs, and back and forth.
Oh, I see.
And we're already starting to see this happen.
Oh.
Canada and Mexico, they've already hit back with counter tariffs. And China's saying they're going to challenge the U.S. Through the World Trade Organization. That CNBC video, it actually showed just how much copper and aluminum the U.S. imports. 36% copper and 82% aluminum.
Wow, that's a lot.
So disrupting those supply chains, well, that could have a big impact on the U.S. economy.
So it's not just about the price of, I don't know, a can of soda going up.
Right, exactly.
This could be way bigger.
It can affect entire industries and make it, a lot harder for businesses to operate. And speaking of feeling the impact, Asian markets, well, they've already reacted pretty strongly to all this news.
Right, you mentioned the Hang Seng and Taiwanese indices taking a hit. What's behind that sell-off?
A lot of Asian economies, they rely heavily on exporting goods to the U.S.
Right.
So if this trade war, if it gets worse, those exports, they could become a lot more expensive and less competitive, which hurts those companies.
Makes sense.
Investors see that risk, and they start selling off their shares, which is why you see those indices dropping. It's like they're saying, uh-oh, this could get messy.
Yeah, uh-oh, for sure.
Yeah.
And then everyone's waiting to see what happens when the Chinese markets reopen after the Lunar New Year. It's like they're holding their breath. Do you think this is a sign of things to come, or are investors just overreacting?
It's hard to say for sure. I mean, there's definitely a lot of uncertainty, and that always makes investors nervous. But it's interesting, right? Because even with all this volatility, the S&P 500 in the U.S., well, it recently hit a record high.
Right, that's what I was thinking too. It's like, how can that be happening with everything else going on?
It does seem a little counterintuitive, right? There's a couple possible explanations. One is that maybe investors are focusing more on those strong corporate earnings. They're seeing those as a sign of resilience in the U.S. economy.
So they're basically saying, hey, companies are still making money, so maybe things aren't as bad as they seem.
Exactly. The other possibility is that this is, what's called a calm before the storm. Maybe the market is enjoying this little temporary boost before the real impact of these trade tensions, well, before they kick in. Either way, it's something the Federal Reserve, the Fed, is definitely watching really closely.
Right, the Fed, they've got a lot on their plate right now.
Oh, for sure.
Inflation's already a concern, and now you add these tariffs to the mix, which could make prices go up even more. What's their plan? What are they going to do?
It's a tough spot, for sure. I mean, those Fed minutes you sent over, they show they're concerned about inflation. They want to see it come down more, further before they even think about cutting rates. But at the same time, they don't want to slow down economic growth by raising rates too fast.
That's like a balancing act.
Exactly. It's really delicate. They're in wait-and-see mode right now. Imagine it like this. The Fed is a pilot flying through really thick fog. They have to be super cautious, wait for the fog to clear, get more data and a clearer picture before making any big changes to their course.
That makes sense. But what does that wait-and-see approach mean for someone like me, who's trying to make sense of all this and plan for the future? Does it just create more uncertainty?
It does create uncertainty, but it also shows how important diversification is in your portfolio.
So not putting all your eggs in one basket.
Exactly. And we're going to get into some specific opportunities a little later. But first, let's look at some potential risks that you highlighted in your notes.
Okay, sounds good. One that really caught my eye was the possibility of the Fed just staying put for a long time, prolonged period of inaction.
Right.
The Yahoo Finance interview with Atlanta Fed President Bostic, he mentioned this could even last until 2025.
Wow.
What would that mean for the markets, for investors?
Well, if the Fed stays out of the game for too long, it could make investors uneasy, especially if economic growth starts to slow down or if inflation stays high.
Right.
That uncertainty could make the market even more volatile.
So buckle up. It could be a bumpy ride.
It's possible. But remember, even when things are turbulent, there are always opportunities to be found.
Okay, I like the sound of that. So let's talk opportunities then. We've got a lot to cover. We've got companies, different sectors, like Ulta Beauty doing surprisingly well. Chevron maybe at a turning point. Even buzz about meme stocks like Hims and Hers.
Yeah.
Where do we even start?
Let's zoom in on Ulta Beauty first. They're a great example of a company that's doing really well despite everything else that's going on.
Interesting.
Their recent earnings report was fantastic, and it tells us something really interesting about how people are spending their money.
Okay, I'm all ears. Why are they doing so well when other companies are struggling?
Well, their strong earnings, they kind of suggest that people are still willing to spend money on things that make them feel good, even when they're feeling uncertain about the future. It shows the power of self-care and how resilient some spending categories are.
So even if I'm worried about a trade war, I still want my lipstick and my skincare routine.
Seems like it. And for Ulta, this means they're in a great position. They've found a need that goes beyond just products. They're selling confidence, a sense of well-being, and that's something people are always willing to invest in, no matter what's happening in the economy.
That's a really interesting point. It makes you think about how companies can adapt, find opportunities even when things are tough.
Absolutely. It reminds us that when we're analyzing companies, we need to look beyond just the headlines and really try to understand their business, their customers, their strategies for dealing with change.
Great point. So while Ulta's doing great, you mentioned Chevron might be at a turning point. What's happening there?
Chevron, well, as a big oil company, they could benefit from the increase in U.S. oil production and what some people call the drill baby drill mentality. They could see their profits surge if oil prices stay high.
So does that mean investors should jump on the oil bandwagon?
Not so fast. There's a lot more to think about.
Okay, like what? Give me the need-to-know stuff.
For one, the energy landscape is changing rapidly, right?
Uh-huh.
This transition to renewable energy, it's gaining momentum, and that could impact demand for oil in the long run.
Right.
So while Chevron might do well in the short term, their long-term success, well, it depends on how they adapt to all this change.
So it's not just about riding the oil wave. You have to think about the big picture and how these companies are preparing for the future.
Exactly. And speaking of the future, let's shift gears and talk tech. You've got some notes about Palantir and their AI work. And then there's Toast. They're changing the restaurant experience. What are you most interested in here?
Honestly, I'm fascinated by how these companies are using technology to solve real-world problems. Palantir with their AI for defense and intelligence, and Toast helping restaurants be more efficient. It's incredible. But, I also want to understand the risks. Is all this hype real? Or are we setting ourselves up for disappointment?
That's a great question. It's one we need to consider carefully. Both Palantir and Toast have huge potential, but they also face big challenges. Palantir, for example, relies a lot on government contracts, so any changes in defense spending could really impact them. And Toast, while they're growing fast, they're in a very competitive market, so they need to keep innovating to stay ahead.
So there's a lot to be excited about, but also a lot to be cautious about.
Exactly. It's about finding that balance, recognizing the potential, but also understanding the risks. And that's where our deep dive comes in, because we can dig into the details and help make sense of it all.
All right, you've convinced me. Let's keep going. What else do we have?
As we're talking about all these companies and their future, one thing that really strikes me is this disconnect between the overall market and what's happening with some individual stocks. It's like two totally different stories going on at the same time.
Yeah, I see what you mean. We've got the S&P 500 hitting record highs, but then some companies like Palantir, they're taking a hit after news about potential defense budget cuts. It's like investors are just freaking out and selling at the first sign of trouble.
It's that classic shoot first and ask questions later mentality. With all this uncertainty about trade wars and the economy, people are just more likely to react emotionally, hit that sell button, even if it means missing out on good opportunities.
Okay, so how do we avoid that trap? How can we as investors stay calm and make good decisions when the market feels like, a roller coaster.
It always comes back to the fundamentals. Instead of getting caught up in the day-to-day noise, you got to zoom out and look at the big picture. Does the company have a solid business? Are they making consistent earnings? What are their long-term prospects? These are the questions that should guide your decisions.
So basically, don't panic and sell everything just because the headlines are scary.
Exactly. Take a deep breath. Remember, investing is a marathon, not a sprint.
All right, I'm taking notes. So as we're looking at these fundamentals, let's talk about a sector that's been getting a ton of attention: electric vehicles. You mentioned Tesla, and I've got notes here about Li Auto, a Chinese EV company, and they're predicting lower sales than expected. What's happening with EVs, and what does it mean for investors?
The EV market is definitely facing some headwinds right now, especially in China, where competition is heating up. Light Auto's sales projections suggest that maybe demand is slowing down a bit, and even Tesla is feeling the pressure. They're actually planning to make a cheaper version of their Model Y in China to try and gain back some market share.
So is this the start of an EV price war?
It's possible, but it's important to remember that the EV market is still really young. It's like the early days of the internet, Lots of hype, lots of competition. Some companies soared while others crashed, but the overall trend was clear. The internet was changing the world, and the companies that could adapt and innovate, well, they were the ones that ultimately succeeded.
So you're saying we're still in the early stages of EVs, and there's still huge potential for growth, even if there are some bumps in the road.
That's how I see it. For investors looking at EV stocks, it's about carefully looking at each company and how they plan to navigate this rapidly changing market. Are they focused on innovation? Are they building a strong brand? Do they have a clear path to profitability? These are the questions you need to ask.
Got it. So it's not just about jumping on the EV bandwagon. You need to be smart and do your research. Speaking of research, you mentioned earlier that we're going to look at some specific opportunities. Is that still on the agenda?
Absolutely. But before we get to those, I want to touch on another sector you highlighted in your notes, the travel industry. I know you've been following this one closely, especially after that Yahoo Finance interview with the CEO of Travel and Leisure. What stood out to you there?
Well, what struck me was his optimism, about the future of travel, even with all the economic uncertainty we've been talking about. He was saying people are still eager to travel, they're booking vacations in advance. He even said that inflation has actually been good for them.
Now, that's interesting. How can inflation be a good thing for a travel company?
Yeah, it seems counterintuitive, right? But here's how he explained it. A lot of their customers have already paid for their vacations up front. So when they actually go on the trip, they're basically getting a discount compared to if they waited and paid closer to their travel dates, when prices would be higher because of inflation. It's like a built-in protection against rising costs.
That's a really smart way to look at it. It shows how sometimes what seems like a bad thing can actually create opportunities for companies that can adapt quickly.
And he also mentioned how this whole work-from-home trend is actually making vacations longer for some people. Because they can work remotely, they can stay at their destinations longer, which is great for the travel industry.
Yeah, that makes sense. The line between work and leisure is getting blurry, and companies like Travel and Leisure are taking advantage of that. It's another example of how these changing work patterns are impacting how people spend money and creating new opportunities for businesses that can adapt.
So even with all this talk of an economic slowdown, there are still areas of strength and resilience in the market. It's not all doom and gloom.
Absolutely. It's a mixed bag, as it often is in finance. But the key is to stay informed, look at the data, and make smart choices based on your own goals and risk tolerance.
All right, I'm ready to get specific. Let's talk about some of those potential opportunities you mentioned earlier. What have you found?
Let's go back to the tech sector. We talked about Palantir and Toast, but there's another company I think we should look at. NVIDIA. They're a leading maker of graphics processing units, or GPUs, which are essential for everything from gaming to AI.
NVIDIA, yeah, I've heard of them. They're big in the gaming world, right?
They are, and that's been a huge part of their growth. But what's even more exciting is their role in AI. GPUs are what power a lot of AI applications, and as AI becomes more and more common, NVIDIA is in a great position to benefit.
So they're kind of a double threat.
Yeah.
They've got the gaming market, and they're also riding the AI wave. That's pretty promising.
It does, but like with any investment, there are risks. Competition in the GPU market is fierce, and NVIDIA needs to keep innovating to stay ahead. And the whole field of AI is still developing, so there's no guarantee they'll be the top player in the long run.
Fair enough. So how do we weigh those risks against the potential rewards? What should investors be looking for when they're checking out a company like NVIDIA?
I think the key is to look at their history of innovation, their management team, their financial strength, and their overall strategy for the future. Are they investing a lot in research and development? Are they making smart acquisitions to expand their capabilities? Are they building a strong network of partners and developers? These are all signs of a company that's serious about growing in the long term.
Okay, so it's not just about the technology itself. It's about the people, the strategy, and the overall vision for the future. Makes sense. What else is on our list of opportunities?
Well, we've talked a lot about U.S. companies, but I think there's also potential in international markets. You've got some notes about the sell-off in Asian markets, and while that might seem scary, it could also be a chance for investors who are okay with a little more risk.
So you're saying that when everyone else is running away, that's actually a good time to look for bargains.
Exactly. When markets overreact to bad news, it can create opportunities to buy good assets at a lower price. Of course, you have to do your research and understand the risks, but for investors who are in it for the long haul, international markets can offer diversification and potentially higher returns.
Okay, diversification, I get it. But how do we know which international markets to focus on? There are so many.
That's where things get interesting. You need to look at things like economic growth, political stability, and market valuations. Emerging markets, for example, often have higher growth potential, but they also come with higher risks. Developed markets tend to be more stable, but they might offer lower returns.
So it's that balance between risk and reward again. Are there any specific international markets you're watching?
One area I'm keeping an eye on is Southeast Asia. Countries like Vietnam, Indonesia, and Thailand are seeing really strong economic growth, and their stock markets are relatively cheap compared to developed markets. They're also benefiting from the shift in global manufacturing away from China, which is creating new opportunities for businesses there.
So Southeast Asia has a lot going for it.
It does, but it's not without risks. Political instability, currency fluctuations, and regulatory challenges can all impact investments in emerging markets. So it's really important to do your homework and understand the specific risks of each country before investing.
Got it. So international markets offer diversification and potential for bigger returns, but we need to be smart and do our research. What else is on our opportunity radar? We haven't talked about those meme stocks yet.
Ah, yes, the world of meme stocks. This is where things get really interesting and potentially risky. We saw those huge swings in Hims and Hers and super microcomputer, mostly driven by short squeezes.
Hold on a second. What's a short squeeze? I've heard that term, but I'm not totally sure what it means.
Imagine a group of investors think a stock is going to go down. They borrow shares of that stock and sell them, hoping to buy them back later at a lower price and make money. That's called short selling. But sometimes the opposite happens. The stock price goes up instead of down, and those short sellers have to buy back the shares at a higher price to cover their losses. That rush to buy pushes the price up even more, and it can get crazy. That's a short squeeze.
Okay, that makes sense. So these meme stocks are getting caught up in these short squeezes, which is why we're seeing those wild price swings.
Exactly. And what makes it even crazier is the influence of social media. Everyday investors are coordinating their buying and selling online, and it creates this herd mentality that can really push prices around.
So it's a mix of short squeezes, social media hype, and a lot of speculation driving these meme stock rallies. It sounds like a recipe for disaster.
It can be. And it's important for investors to remember that these rallies are often based on emotion and momentum, not on the fundamentals of the company. So while it might be tempting to jump on the bandwagon, you really need to know the risks.
Got it. So meme stocks, high risk, high reward, and not for the faint of heart. What else is on our opportunity list? I'm curious what else you've been looking at.
Well, one area that I think people often overlook is real estate. You've got some notes here about Toast opening new restaurant locations like crazy, and that's just one example of the growth we're seeing in commercial real estate.
Okay, tell me more. What's driving that growth, and how can investors get in on it?
There are a few things happening. First, the economy is still pretty strong and businesses are expanding. Second, interest rates are still low, which makes it easier for businesses to borrow money and invest in new properties. And third, there's a lot of innovation happening in real estate, from new technologies for managing properties to new business models like co-working spaces and flexible offices.
So real estate isn't just about buying and holding property anymore. It's becoming more dynamic and innovative. How can investors take advantage of this growth?
There are a few ways. You can invest directly in properties, but that takes a lot of money and expertise. You can also invest in real estate investment trusts, or REITs, which are companies that own and operate income-producing real estate. REITs offer diversification and liquidity, and they can be a good way to get exposure to the real estate market without having to manage properties yourself.
So REITs are kind of like mutual funds for real estate.
That's a good way to think about it. They let you invest in a variety of properties without having to buy and manage them yourself.
That's interesting. I'm definitely going to learn more about REITs. So we've talked about a lot today. Tech, EVs, travel, real estate. What's the main thing you want our listener to take away from all of this? How can we use this information to make good investment decisions?
I think the most important thing is to understand that the world is changing fast, and the markets are reflecting that. New opportunities are popping up all the time, but there are also new risks to think about. The best way to handle all of this is to stay informed, do your research, and be ready to adapt your investment strategy as things change.
So be flexible, be curious, and be willing to learn.
Exactly. And remember, you don't have to do it alone. That's what we're here for. We're your guides through the world of finance.
All right, I feel like we've covered a ton in this deep dive. But before we wrap up, there's one thing we haven't talked about yet, and it's something I've been thinking about a lot lately. Ethics in investing. It seems like more and more investors are thinking about the environmental, social, and governance ESG factors when they make investment decisions. What are your thoughts on this trend, and how can we incorporate those considerations into our own portfolios?
It's definitely a trend that's gaining traction, and I think it's a good thing. Investors are realizing that they can use their money to not only make money, but to also make a positive impact on the world. ESG factors, those are becoming more and more important in investing, and companies that ignore them, well, they're doing so at their own risk.
So it's not just about profits anymore. It's about making money in a way that aligns with your values.
Exactly. Investors are asking tough questions like how are companies affecting the environment? How are they treating their employees? How are they governed? And they're putting their money where their mouth is, so to speak.
Makes sense. But how do we actually incorporate ESG factors into our own portfolios? It seems like a lot to keep track of.
There are a few ways to do it. You could invest in those ESG-focused mutual funds or ETFs.
Right.
Those funds specifically target companies that meet certain ESG criteria.
Okay.
Another option is to use those ESG ratings, to evaluate individual companies. There are organizations that provide these ratings, and they can give you a sense of how companies are doing on those factors.
So there are tools and resources out there to help investors make more informed decisions.
Definitely. And it's getting easier all the time as more data becomes available and as more investors demand transparency.
That's great to hear. Seems like ESG investing is becoming more mainstream, but are there any challenges or limitations to it?
One challenge is that ESG data can be subjective and not always consistent. Different rating agencies might use different methods, so it can be hard to compare companies directly. Another challenge is that there's no guarantee that those ESG-focused investments will do better than traditional investments. Some studies have actually shown there's no clear link between ESG performance and financial performance.
So ESG investing might not necessarily lead to higher returns.
It's not a magic formula for getting rich, but for a lot of investors, it's not just about making the most money, it's about aligning their investments with their values, making a positive impact. And I think that's a powerful thing.
I agree. It's about investing with a purpose. Okay, so we've covered a lot today, from trade wars and the Fed to specific companies and sectors, and now ESG investing. What are the key takeaways you want our listeners to remember?
I think the biggest takeaway is that we're living in a time of, huge change and uncertainty. The markets are volatile, the economic outlook is shaky, and the geopolitical landscape is constantly shifting. But even with all that, there are amazing opportunities out there for investors who are informed, who can adapt, and who have a long-term vision.
So it's not about freaking out and selling everything. It's about staying calm, doing your research, and making smart decisions.
Exactly. And remember, diversification is so important. Don't put all your eggs in one basket. Spread your investments across different asset classes, sectors, and regions. Think about your risk tolerance and how long you plan to invest. And most importantly, invest in what you believe in.
Great advice. And speaking of believing in something, you mentioned earlier that there was one more thing that really stood out to you from all the information we talked about. What was it?
It's how everything is connected. We talked about trade wars, technological innovation, changing consumer behavior, and the rise of ESG investing. All these trends are intertwined, and they're shaping the future of the global economy. It's a complex and really fascinating time to be an investor. The choices we make today, they'll have consequences for years to come.
That's a really powerful thought. It makes you realize that investing isn't just about numbers. It's about understanding the world around us and how we can be part of creating a better future.
Exactly, and I think that's an exciting thing.
I couldn't agree more. Well, I think we've given our listeners plenty to think about today. Thank you for joining us on this deep dive into global markets and investing.
It's been my pleasure. Remember, knowledge is power. The more you know, the better prepared you'll be to navigate the financial world.
And remember, stay curious, stay engaged, and keep learning. Until next time, happy investing.